Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're digging into Uniper's first half 2025 results. And really, this whole story is about the company's big shift into a new, what they're calling, normalized strategic chapter.
Okay, so let's dive right in. The big question on everyone's mind is this. Is Uniper's performance a smart, disciplined pivot toward predictable growth? Or are they just kind of treading water after a period of just unbelievable volatility? We're going to unpack the numbers, the strategy, and what to watch for to figure that out.
All right, first things first, let's get a handle on the headline numbers. After a pretty rocky start to the year, the second quarter really showed a significant turnaround, and that's where the story gets interesting. So, Uniper came out with a really solid Q2 adjusted EBITDA. We're talking 518 million euros. And look, this number is a big deal because it's a huge swing back into the black after a pretty rough first quarter where they actually reported a loss of 139 million euros. So this isn't just a recovery, right? It's them planting a flag for stability. Okay, so that strong Q2 brings their total first half adjusted EBITDA to 379 million euros. Now that number was right in line with what everyone expected, but, and this is the key point, it is a completely different universe from the crazy 1.743 billion euros they pulled in during the first half of 2024. That contrast, right there, is the normalization story. And this is where management really shows its confidence. They didn't just reaffirm their full-year guidance, they actually tightened the range, lifting the bottom end. For you, the investor, this basically screams that they have a very firm grip on the wheel and a clear view of the road ahead for the rest of the year. So how did the market react to all this news? Well, pretty much with a shrug. The stock closed completely flat. And what that tells us is that investors had already baked this whole return to normal story into the price. A big surprise could have sent it soaring, a miss would have been punished. Flat means the market thinks Uniper is doing exactly what it said it would do. So, if those exceptional, volatile earnings are a thing of the past, how is management steering the ship now? The answer is a really clear and decisive pivot, away from market volatility and straight towards predictable, contracted cash flows.
And the engine driving this whole pivot? It's a massive 8 billion euro transformation plan. The company is already committed to spending 5 billion of that by 2030. Now, the key thing for you to watch is where that money is going. And it's heavily skewed towards their generation assets to build a more resilient future.
And they're deploying that cash across a pretty straightforward three-pillar strategy. First, they want to grow their flexible power generation with new gas plants that are future-proofed for things like hydrogen or carbon capture. Pillar 2, rebuilding their gas and LNG business, but this time focusing on stable, long-term deals. And finally, number 3 is just driving efficiency inside the company, which includes reducing about 400 roles and a new partnership with Microsoft to deploy AI. You know, this quote from the CEO, Michael Lewis, just nails the whole strategy. When he says they want to reduce merchant exposure, he's basically saying, we're tired of being at the mercy of wild daily price swings in the energy market. The whole game now is to de-risk the business for more predictable earnings. All right, so that's the strategy on paper. Let's take a look at how it's actually playing out in their different business segments, because you can already see that earnings mix starting to shift.
And honestly, this is exactly what you'd expect in a so-called normalization year. On one side, you've got green generation doing better, mostly because they have fewer of those one-off charges this year. But then on the other side, flexible generation and greener commodities, they're trending down. And that's no surprise, really. It's because those super high margin hedges, think of them like killer insurance policies that locked in high profits. Well, those are rolling off and trading conditions are just back to normal.
So let's put it all together. We've got the solid results, this big strategic pivot, the shifting earnings. What's our final call on Uniper stock going forward? But before I give you a rating, we absolutely have to talk about the catalysts. I mean, what are the key events or milestones that are going to make or break this strategy over the next, say, 6 to 12 months? From here on out, the whole story is really about one thing: execution. So as an investor, here's what you need to be watching like a hawk. more clarity on those delayed gas plant auctions in Germany, real progress on their UK carbon capture projects, and of course, new long-term gas contracts to prove this de-risking strategy is working. And finally, any progress on divestments and steps toward reprivatization, that's what's going to signal they're truly back to business as usual. So, taking all of that into account, our rating is market perform. Look, Uniper is running a smart, pragmatic playbook for the world they're in now. But, and this is a big but, those major regulatory and project delays hang over everything, creating a pretty guarded outlook. The potential upside is definitely there, but the key question for investors is simply this: how long are you willing to wait for those outside catalysts to actually happen? And of course, as always, this is not financial advice.